HIMS and HERS is up 150% year to date, and many people are actually wondering whether or not it's too late to start a position, and that is the question we aim to answer in this video. You see, earlier on in the year, I created a couple of videos where I spoke about 4 different companies that I'm extremely interested in going into 2025, and out of the 4 companies, HIMS was actually one of them. Now, had I actually allocated an equal amount of money into each of these 4 companies, I would have been up 36% year to date. But because of my portfolio allocation among these 4 companies, I only find myself up 12% year to date. And so I'm sat there looking at the portfolio and wondering to myself whether or not the valuation in HIMS actually makes sense and whether or not it still has the potential to go even further. But as always, potential is a dangerous word, so let's dive in. The starting point of this video actually comes from one of the biggest lessons I've learned over the years in the markets, and that is the fallacy of buying the dip. You see, when I first did my valuation video on HIMS, I thought that it should be easily worth somewhere in the $40 range. But now that we find this company trading in the $60 range, we have to ask ourselves the question whether or not the business has fundamentally changed. Is it actually time to sell, or can we actually add more at these levels? I think right now, if you go out into the streets, you ask anyone with some sort of background in investing, they're likely to tell you that buying the dip is a good thing. But if you take a look at this chart over here, HIMS hasn't exactly dipped. In fact, since the last time I posted a video about HIMS, the stock has absolutely skyrocketed. So why is it I'm talking about this? Now, I really need you to hear me out. Now, personally, when I first started investing in the stock market, I had this misconception thinking that the whole point of the stock market is for me to lower my cost basis on companies that I own. However, I've come to realize over time that that is not the aim of the game, because the real game in the stock market, the real way to win in the stock market, is to accumulate as many shares as we can so that we get a bigger slice of the pie. Now, bear in mind, I'm not saying that valuation doesn't matter and asking you to go out and indiscriminately just buy shares of companies that you like. But valuation is not solely tied to price, and I'm going to prove that to you. So I'm going to use a very drastic example over here. This is the chart of company A, and this is the chart of company B. Now, assuming that back in the year 2000, on the 3rd of April, year 2000, you actually invested $1,000 equally into both of these companies, right? Company A is trading at about $1.20, and company B trading at $82. Now, fast forward 15 years, it is now the year 2015, and the situation is that you only have $1,000 with you. Now, you're not able to split this $1,000 up into $500 and invest equally into both companies. You only can pick one of these 2 companies to basically add your capital to. So would you invest in company A, which is trading at around $30 per share, where your money actually already grew by 30x? Or would you choose to lower your cost basis with company B because you bought it at $80 a share, and if you bought extra shares of company B at $30 per share, you will be able to lower your cost basis down to $55. Fast forward to present day 2025, this is what actually happened to both of these companies. Now, the first company over here, company A, is actually Apple. And so what happened is that your initial investment of $1,000 between the year 2000 and 2015 grew from $1,000 into $30,000. Now, after you added the $1,000 of additional capital to Apple, now you would have $31,000 worth of Apple shares. And today, that $31,000 would have become $248,000, which means that is another 8x from where it was in 2015. Now, on the other hand, if your focus was on reducing your cost basis and you actually bought company B is actually Cisco. Now, between the year 2000 and 2015, your investment in Cisco would have went from $1,000 all the way down to $365. Now, after adding the extra $1,000 of capital into your investment in Cisco, you actually brought your cost basis down all the way to $55. Now, from the year 2015 all the way to today, if you were to sell all your shares today, these shares will only be worth $1,613. And so, ladies and gentlemen, we actually feel safe. Many of us, I know, we feel safe buying the dip. But the truth is, if you actually pick great companies in the stock market, you're likely going to have to increase your cost basis over time, because the whole game, or the whole point of the stock market, is for you to own a larger slice of the company, to own a bigger share of the company at a good valuation, and not only being focused on price. So buying the dip is a fantastic strategy if done correctly, if you know what exactly you are buying. If we take a look at the Apple chart over here, right, you could have bought the dip here, here, and over here, but each dip that you bought would always be higher than the previous dip. And so I'm bringing this up because people have asked me whether I'm going to continue adding into positions like HIMS and SoFi, which are up 150% year to date, up over 100% in the last couple of months. And that is the whole premise of this video. Because the price has changed, so has the valuation. And for me, the decision whether or not to buy and sell a company is not just down to price, but is dependent on macro tailwinds, the market opportunities in front of the companies, as well as valuation. Now, when we talk about, the macro tailwinds in front of the company, market opportunities, as well as valuation, there is nuance here because we have to measure the effect that each of these components has on the company. Now, I was ever caught being overly fixated purely on valuation, and because of that actually caused me to miss opportunities in the stock market. And so I've always been learning and adjusting my framework to better consider all of these factors. But at the same time, I have also found myself in similar situations where buying at good valuations actually saved me a world of pain. So I really do believe that this is not a either or pick one or two, but finding a balance in all three aspects of a business. So when it comes to HIMS, I think understanding the macro tailwinds includes understanding the healthcare landscape, which I think I've mentioned before. Personally, I'm still learning much about the industry as this is a fairly new investment for me. But Trump's appointment of Dr. Marty Makary as the FDA commissioner might be a tailwind for HIMS. Now, I was just, Googling him a little bit more, as in Dr. Marty Makary, and listening to some of his podcasts, listening to what he has said or his stance about compounding medicine and things like that. I think in his book, Blind Spots, he actually recognizes that GLP-1 medications can actually be beneficial for both weight loss and reducing certain health problems. But despite of all these benefits, I think he takes a more measured approach. He actually urges consideration of the unknown long-term ramifications of GLP-1 usage. So I think all in all, I wouldn't say that he's exactly pro-compounding, but neither is he against compounding, and that is a plus because he really believes that people should think critically about healthcare, and healthcare should be evidence-based. And so to me, the way I look at it is that if HIMS continues to produce quality products and provide credible, substantiated research, they should do well under this administration. And I think at the very least, some of these appointments that Trump has made, including RFK Jr., has been seen as somewhat, leveling the playing fields for HIMS versus the big boys. Now, at the same time, I also want to be aware of potential headwinds, primarily when it comes to GLP-1. I think should certain drugs be taken off the shortage list, the fear could actually cause the stock to pull back, or if some of the big companies actually put pressure on HIMS to stop selling their compounded version of the drugs, the same thing could happen. Now, in my previous video, I actually said I wouldn't be surprised to see HIMS at $12 or over $40 by the end of 2025. Now, a lot of you ask, why did I say $12 and how can it go down to $12? And all of this is largely dependent on when you actually watch that video, because when I first posted that valuation video about HIMS and hers, it was actually bouncing around in the low to mid $20 range. And basically all I was saying in that video is that I wouldn't be surprised if the stock price actually doubles from there or gets cut in half by the end of the year. And to me, that sentiment still holds true. And so if you ask me from where HIMS is actually trading today in the $60 to $70 range, for it to fall all the way back down to $12, something absolutely catastrophic needs to happen. But I wouldn't be surprised for some unsubstantiated news to come out and for it to pull back another 30, 40, even 50% back to the $30 to $40 range. And for people who are interested in opening a position in that company, that might make a good entry point for you. And when it comes to opportunities, I do believe that the market that we have in front of HIMS was much bigger than I first thought. Now, looking at the speed of their execution when it came to GLP-1s also shown me basically how fast this company can move to capture new markets and build out entire new verticals. I think unfortunately right now, with where the world stands, with the type of food that we consume, with our lifestyles being more and more sedentary, I think more people are suffering from a variety of different health issues. This can range from obesity to mental health. And as we know it, the cost of healthcare is increasing at a very rapid rate. And these two factors combined together really presents a real need in the world today that HIMS is well positioned to meet. Now, I actually took this graphics from one of their previous earnings call where you can actually see the different verticals that they actually think about and plan to expand into and the various subcategories within a single vertical. And so as long as people need affordable healthcare and personalized treatments, HIMS total addressable market will keep growing. And the more I look into their business model, what I've really come to realize and appreciate is that healthcare subscriptions can be very sticky. I would think actually even more so than software subscriptions, or if you consider relationships with financial institutions, now it could really be a hassle, right, to change from one financial institution to another. But at the end of the day, at least in Singapore, within 2 to 3 hours, I could switch all of my salary deposits and my gyro payments from one bank to another. However, if I actually found a perfect healthcare solution that works for me, that is personalized to my needs, to build up that same amount of patient history and understanding with a new pharmacy or clinic requires a lot of friction. And so because of that, people are less likely to do that. So let's put it this way, right? If people don't cancel their YouTube premium when YouTube raised their prices or when Netflix raised their prices, why would they cancel a treatment plan that is actually tailored to their needs? At the end of the day, valuation matters, and over time I've learned to be okay to buy above valuations in some companies because macro tailwinds and market opportunities just lined up. And for companies like that, they tend to trade at a premium for an extended period of time. Now take Palantir for instance, it's definitely trading at a crazy valuation, and while the market is bullish and the AI narrative is strong, it can definitely sustain this valuation. But buying at a good valuation protects you in a down market. You see, the person buying Palantir in the $10 to $20 range, even $30 range, is in a much safer position today than the person buying it in the $110 to $120 range. But if we take a look at HIMS valuation today, HIMS is currently trading at around 10 times price to sales. And if you look at its competitors, Eli Lilly, it's trading at around 16 times price to sales, and Novo Nordisk is trading at 8.5 times price to sales. However, if we take a look at the growth rate differs greatly. HIMS is actually growing revenues at around 56%, while Eli Lilly and Novo Nordisk are actually growing revenue at only around 26 to 27%. Now, 26 to 27% is still fairly good growth, but it's nowhere near the 56% that HIMS is putting up. So on an absolute basis, yes, you can actually say that the 10 times price to sales is a pretty rich valuation, but relatively speaking, for where we are in this macro environment with comparable companies in the sector, it is not crazily overvalued, but it is definitely priced for perfection. Now, if you are looking at profitability metrics on a price to gross profit basis, HIMS is trading at around 13 times, and on a price to free cash flow basis, they're trading at around 84.2 times. Now, if you were to compare this to some of the other companies, Eli Lilly's free cash flow is actually negative due to lower than expected sales and investment into expanding their manufacturing capacities. So it's a bit hard to do the comparison right now. But with Novo Nordisk basically has around $2.25 of free cash flow per share, which works out to be around 36 times price to free cash flow. And so on the surface, that makes HIMS look crazy expensive, but we have to consider where each of these companies are in the business cycle. And so one of the things that I found it to be effective to actually determine whether or not the company can actually sustain its valuation, apart from understanding the macro environment, is to actually hold management to their word. And if management can keep their word, they will eventually grow the company into that valuation. And so to me, the main growth driver surrounding HIMS, or the whole thesis surrounding HIMS, is its member growth and the number of subscribers on a personalized solution. Now, I really believe that at least in the first half of 2025, GLP-1s will continue to be a growth driver for HIMS. Now, as we have noticed in the last couple of quarters, in fact, before the introduction of GLP-1s, HIMS was actually growing their subscriber count at around 41% year over year. However, that actually accelerated in Q2 of 2024 because they introduced the GLP-1 into their lineup in around May of 2024. So therefore, coming into 2025, as they actually grew their subscriber base last year, purely by virtue of the law of large numbers, I expect the growth rate to continue to drop but stay at a healthy range. And so basically moving forward into 2025, I actually expect them to grow member counts anywhere between 37 to 40% throughout the whole of 2025. Now, on top of that, we really noticed the boost in monthly online revenue generated per average subscriber in Q3 2024, and that was actually because they operated an entire quarter with their full GLP-1 offering. And so that basically pushed the monthly online revenue generated from the $50 range all the way up to $67 per subscriber. And we want to see in the fourth quarter of 2024 whether or not this number remains strong so that we can have a better idea on where this will level out. But for now, now I think the assumption is that it will stay in the $60 range, at least in the first half of 2025. So what I've done here is slightly different from what I've done with SoFi. Now, there's just one asterisk over here. Now, I realized when I take the total number of members multiplied by the average revenue per subscriber, this revenue number actually differs slightly from their total online revenue that is reported, but I'm guessing because the numbers are pretty dynamic throughout the whole quarter, and this is just basically an estimate of what we can expect revenues to do. However, the numbers are actually quite close, so it's to me quite a good ballpark of where their revenue number will end up. However, their 2025 numbers is dependent on where their Q4 numbers end up, and that's exactly where we want to start. Now, in the fourth quarter of 2024, if member growth basically comes in at around 7.5% quarter over quarter and 43.1% year over year, they will end the year with around 2.2 million subscribers. Now, if the average revenue per subscriber stays the same at around $67, because it does tend to stay within a certain range unless a new product is released, and if the average revenue does stay the same, we are basically expecting a full year revenue of somewhere around $1.45 billion, and that is actually slightly lower than their guidance, so it could even be better than this. So from here, we can actually apply a gross margin of 77% to their revenues to actually find out their gross profit, and that would make gross profit come in at around $1.1 billion. Now, the reason why we are using 77% is that because this is management's long-term target, right, to have gross margin basically level out in the mid 70% range. So in terms of free cash flow margin, we basically expect that to stay constant as what they have done in 2024, around 18%, which means the free cash flow for the entire year would come in at $261 million. Now, importantly to consider is that they also have 218 million shares outstanding. From here, if we apply similar multiples to find its market cap, at 10 times revenue, 12 times gross profit, and 70 times free cash flow, we end up with an average price of HIMS to be around $74.47. Now, if we take a 20% margin of safety from here, that would put the fair value of HIMS at around $59.57. But that's only if you believe in their execution. Now, I want to look ahead to the rest of 2025. Now, if HIMS is able to grow its subscriber count at 37% year over year, with the monthly online revenue per subscriber coming in at least $65 for the first half of the year before falling off to around $60 in the back half of 2025, we would actually still have revenues come in for the entire year at $1.9 billion. Now, if we were to take a 77% gross profit margin, which is what we did previously, gross profit would come in at $1.59 billion. And if we assume the free cash flow margin stays the same at 18%, the full year free cash flow in 2025 would be around $359 million. So if we do the same thing and apply all these multiples, the price to sales multiple to the revenue and price to free cash flow and things like that, as well as consider a 4% dilution, we can actually find the price or the expected price target for HIMS in 2025. So with a 4% dilution, that would make the shares outstanding for HIMS come in at around 227 million. Now, so with that, on the price to sales basis, HIMS should be trading at around $88, and on the price to free cash flow basis, it should be valued at around $120. And so if you take an average of that, that will put the price target in 2025 for HIMS at around $96 per share. But if we apply a 20% margin of safety, and the reason why I'm applying this margin of safety over here is because to me, there's a little bit more uncertainty around HIMS' whole business model compared to SoFi. So that's why I'm applying a 20% margin of safety over here, right? Because it can be very easily affected by regulations and things like that. So if we apply a 20% margin of safety, that $96 would become $77. So that is around, slightly less than a 10% upside from here. So this is also assuming a strong macro environment as well as favorable conditions or favorable regulations, allowing them to continue selling their GLP-1s, which is why I made the comment earlier on in the video that HIMS could actually be priced for perfection. If we do end up seeing a weaker macro environment, or if HIMS isn't able to keep up the same level of execution due to regulation and competition, things could actually turn out very, very differently. You see, just 6 months ago, HIMS was actually only trading at 5 times sales, and with a free cash flow per share of 42 cents, they were actually trading at 57 times price to free cash flow. Now, if we apply these numbers to the current expectations, then HIMS should be trading at a fair value of around $46.30. But if we account for the slower macro by reducing the monthly revenue per member to $57, which is what they actually did previously before the introduction of GLP-1s, then with a 20% margin of safety, the fair value of HIMS should come in at around $42.30. So the valuation of HIMS really is dependent on what you believe about the macro environment, about the regulations, and their ability to execute in these environments. And that is the risk and trade-off that we each must decide for ourselves when we choose to invest in a company that is in the growth phase, right? Volatility is just all part of the game, and in a 1 year time frame, really anything can happen. But I do think that overall this will be a good year for HIMS, but of course nothing is certain, and that's why for me personally, I'm not actually looking to add over here. I'm happy to add again in the $40 range like I was just showing you, and with that I'll see you in the next one.